The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner, and over the next half an hour we'll tell you why is it important to actually monitor your portfolio and do that on a regular basis to ensure you're investing wisely. Well, to talk about that with us, we've got with us Hemant Rustagi, CEO of Wiseinvest Advisors, joining us. Thanks, Hemant, for joining us. Hemant, of course, early this week we were talking about the importance of investing wisely and how it's important to do it in a disciplined manner to create long-term wealth. Of course, a crucial part about investing wisely is also sort of monitoring it on a regular basis, right? Because if you're not really monitoring it, you would probably not know whether or not you've invested wisely to begin with. Why is it important to monitor your portfolio to begin with?
I think you're absolutely right. Monitoring your portfolio is as important as investing wisely, if not more. Because, we're living in an environment where it keeps changing. You see economic environments keep changing, the markets keep behaving differently over different time periods. It is very important to ensure that your portfolio is in sync with the changing environment. Now, this is not to say that every time you see a movement in an asset class, you make changes in the portfolio. Last week we talked about importance of asset allocation. The objective of going or following a philosophy of asset allocation is to make sure that you remain disciplined about your exposure to different market segments. But within an asset class, suppose you're talking about investment in equity, you don't have to change your allocation depending on the market mood. But if there is a change in the environment, if a particular industry or a particular sector is not doing well, and if your portfolio has slightly higher exposure to that, you need to make sure that you realign your portfolio in line with the changing environment and make sure that your portfolio remains on track to achieve all your investment goals, be it short-term, medium-term, or long-term.
Right. Hemant, also, of course, how should one monitor their portfolio regularly?
Well, first thing I would say that every investor has to make, monitoring portfolio as a habit. What we see from investor is many investors, they leave it to their advisor. They think that if there is an advisor who's advising me, there is no need for me to actually monitor my portfolio. I can understand it's quite reasonable to expect your advisor to actually monitor your portfolio for you and then keep telling you as to what you need to do. But at the same time, we cannot shirk the responsibility for taking care of our money. So it's very important that as an investor, we get into the habit of monitoring portfolio. Now, that can be a little tricky for someone who's beginning to invest it. For that, what one needs to do is to have certain benchmark. What are these benchmarks? Every fund that you invest, for example, if you talk about mutual fund, has a benchmark. If you're investing in an equity fund, it may have a benchmark as, let's say, BSE 100 or BSE Top 200. Look at how the fund has done vis-a-vis its benchmark, which is very easy. All this information is available. You have fact sheets coming from the fund houses. You can go to the website of the fund house and look at how the fund has done. There are portals. It's available in the media. Again, there are a lot of analyses which are being done by the electronic media as well as the print media. So look at basically how the fund has done vis-a-vis its benchmark. The second important thing is look at how the fund has done vis-a-vis its peer group. Now, when we talk about peer group, what we're talking about is if we have invested money in a fund which is a mid-cap fund, you need to compare its performance with other funds in the same group. Because if you look at only the benchmark, it may not tell you the clear picture. The fund may have done well compared to a benchmark. Let's say it's given you 3% more than what the benchmark has given. But if the average rate of the funds in that particular segment have given 5 or 6% higher than that, that means your fund which you're invested your money in has not done well. Third is you can have your own personal benchmark. Now, that is very important because when you invest in equity, you may say, look, I'm getting 7 or 8% from traditional options. For the risk that I'm taking of investing in equity, I should get 4 to 5% more. So your benchmark is, let's say, 12%. The moment you're clear about your benchmark, it stops you from taking unnecessary risk. Then you're not chasing big returns. Then you're not going on for very, very aggressive fund. You are happy with 12%, but at the same time, like I said earlier, monitoring ensures that you are not invested your money in fund which has not been performing. The second is the monitoring is also important because it ensures that your portfolio remains on track all times. Otherwise, if you don't look at it on a regular basis, you won't know because you have a time horizon of, let's say, 10 years. You can't wait for 10 years, the time horizon, to get over and see how your portfolio has done. So I think get into habit of monitoring your portfolio. Again, it may sound a little difficult, but there is so much information available, and it's a simple process. Like we talk about different benchmarks. If you have those benchmarks, it's much easier to monitor your portfolio.
And what are those benchmarks that one should keep in mind? I mean, of course, long-term performance, like we talked about earlier this week, is also very important. But you've also said quality of holdings, the sort of investment that the fund makes is something else that people should watch out for.
It is very important. You see, some of the fund we invest in, I'm talking about especially the market-related products, traditional options and all, there is no question of looking at the portfolio. When we talk about, let's say, an equity fund, and some of the fund typically have a very well-defined investment goal, objectives. You have a fund called, let's say, DSP BlackRock Top 100. Now, this fund invests only in the companies out of top 100 companies in terms of market cap. So it's a very, very well-defined investment horizon. Then you have a fund called, let's say, SDFC Top 200, which picks company from, the companies which are a part of BSE 200 index. Very few fund will have this kind of clearly defined, investment universe. For the other funds, you need to look at how good the quality of the portfolio is. Now, it is not easy for an investor who is not well versed with how to pick companies, how to select companies. It's very important then to maybe take help of a professional. And this information is also available. We talk about different medias where this information is available. I think each fund is analyzed in all these places. One can actually ensure that the fund where you invested your money has a good quality. And why it is important is, when we talk about performance, when we talk about analysis of performance, if the market has gone down and your fund has also gone down, there's no need to worry. You need to look at how the segment where you invested has done well, how the market has done well overall. But if the portfolio value has gone down or the NAV of a fund has gone down because of the poor quality of the portfolio, then the chances of recovery are not going to be there. So make sure that if there is a fall in your value of a portfolio, it is only because of the market, not because of bad quality of the portfolio. And if you have invested in a portfolio which is not good, I think the best thing is to not to get emotional about it. Take out your money from there, invest your money in a fund which has a better quality portfolio, and that will enhance your returns over a period of time.
Hemant, we always tell people that they need to invest for the long term, not get caught up with the volatility of performance. So on one hand, if you're telling individuals to monitor their portfolio on a regular basis, on the other hand, we tell them to invest for the long term and not get caught up in the short term sort of performance of a fund. How do these two really work? Because they're pretty much opposite of each other, but both are equally important, right?
Oh, I think it's a very interesting question, I would say. You see, the commitment when we talk about investing for the long term is with the asset class, not with the investment option that you invest in. When we talk about investing for 15 years to achieve your long-term goals or 20 years to achieve your long-term goals, you are committed to an asset class called equity. Now, it doesn't mean that you will not look at your portfolio. When we talk about monitoring, you're only ensuring that the fund where you have invested your money is performing in line with this peer group, is performing in line with the market. We are not saying that you take out your money from one asset class. This is what exactly we have been saying. That follow asset allocation model. Do not get tempted to time the market. Do not try to take out the money, when you feel that the markets have peaked out. That can misfire. So the commitment should be for the asset class. At the same time, monitoring ensures that the money that you have invested in the funds are doing well, especially when compared with the peer group.
You also say follow a very clear-cut strategy when to sell as opposed to only when to buy. How important is that? How important is timing the right time to sell?
Well, it is very important. In fact, having a strategy means that you don't try to time it when it comes to selling. It's quite amazing to see a lot of investors who spend so much time when it comes to investing. Okay, so they will have a financial plan and they look at their asset allocation. The moment that market turns volatile, suddenly you see them exiting from the market. And that is what exactly I'm trying to say. It's important to have a strategy to sell, now, which means that you should be selling a fund only if your investment plan wants you to exit from a particular fund. It could be that you have invested in a particular fund with a time horizon of 10 years. As you approach that period, a year before or so, you start exiting from a fund to ensure that all the gains that you have made are protected. Or if there is a change in your own circumstances, it can happen over a period of time. So you should exit only, like I said, if your investment plan wants you to do it, or if there is a change in the circumstances. Or the third reason could be that if the fund has changed its strategy or policy and you're not comfortable with that, in that case you exit. So having a strategy means that you will avoid the temptation of getting out at the wrong time, because many a time we see investors exiting when the markets are low. That obviously can make a big dent in the kind of return they can get over a period of time.
But also, time diversification is what you said. I think this comes back to a question about timing the market and making the right investments at the right time. How important is time diversification?
It is very important. You know what time diversification practically means, that you remain invested through different cycles in the market. This is what exactly we have been discussing earlier, that don't get tempted to take out money when you see the market not going in the right direction according to your thinking. So if you follow a process of time diversification, you will allow your money to remain invested over a period of time, and in fact you will benefit. So if you combine that with your systematic investment or a disciplined approach, I think you can get wonderful results from your portfolio. Right.
Very lastly, Hemant, very quickly, how often should one revisit their portfolio?
Well, I would say maybe once or twice in a year. Okay. You can keep looking at your portfolio on a monthly basis as to see how your fund is doing. But when it comes to review, ideally it should be once in a year. And the reason for that is there is something called rebalancing of the portfolio. You know, when we talk about asset allocation, suppose you begin with 50% equity and 50% debt. Right. After 1 year, you see your equity has gone up to, let's say, 70 and debt has come to 30. So you rebalance your portfolio. And the advantage of doing it after a year is it becomes more tax efficient, because we talked about long-term returns becoming tax-free. So once in a year, it can be done for analyzing how the fund performance has been, and also with the view whether you require a rebalancing of the portfolio or not.
Well, there you go. That's the importance of why you should be monitoring your portfolio on a regular basis. Review that portfolio of yours on annual basis. And, of course, don't get too emotional. So if an X fund is not working for you, make sure you sell it. Don't get too upset or wound up about that. On that note, we'll take a quick commercial break. But when we come back, we'll take up all your financial planning-related queries with Hemant. So stay with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. It's now time to take up all your financial planning-related queries with our expert.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming in from Sujata. Actually, she says the monthly income is 1.5 lakhs and the monthly expenditure is 75,000 rupees. She has 2 residential plots worth 80 lakhs. She's got a Shriram pension plan with a yearly deposit of 50,000. 3 endowment policies with LIC worth 18,000. And she's got about 5 lakh rupees in cash and no other deposits. Please suggest a proper investment planning to achieve the following goals. She wants to buy a house within 2 years. She wants funds for education of a child who's 9 years old. So she's looking at about 25 lakhs. We don't know in how long. She's looking at a daughter's wedding, which she needs about 80 lakhs for, and a retirement fund of about 2 lakhs after 20 years.
Yeah, I think here again, let me begin with the risk cover. As I always say, I think the first step has to be to ensure that one is adequately insured here. If I look at the combined income of the family, it's around, I think, 1,50,000 a month, which makes it 18 lakh annually. Now, if I go by the thumb rule that we talked about earlier, they require basically an insurance of roughly around 1.80 crore. They only have 2-3 endowment policies. You know, when we talk about traditional policies like endowment policies, surely they are not getting adequate insurance cover. So I think it's very important for them to ensure that they go for a term policy and make sure that they're adequately insured. I think that should be the first priority. Then if I come to goals, the first goal is to buy a house, you know, in 2 years, and the cost they're talking about is roughly around 70 lakhs. The only investment that they have is 5 lakh rupees cash, and there are 2 residential plots here. Now that's very, very important. Now, in time horizon for 2 years, which means that they definitely have to go for a housing loan. Even to get a housing loan, they will require to, you know, make provision for margin money. Even if I take 20% of that, they roughly need around 15 lakh rupees for that. 5 lakh, generally I would not recommend touching it, because that would be your cash reserve. Maybe a part of it can come. The fate of 2 plots will depend on whether they are looking at constructing a house or buying a plot. If they're looking at buying a flat, then maybe they can sell those plots at that point of time. And for the next 2 years, if I look at amount they're saving, they can save roughly around 50-60,000 rupees per month. If I see the difference between the income and the expenses that they're talking about, even if they invest 50,000 rupees, they can create a corpus of around 13-14 lakhs, so which can be used actually as a margin money. So as far as the house is concerned, I think they need to first focus on creating a corpus for the margin money, and then they need to go for a housing loan. Now, if we get to other investment goals that they have, the first one is for the daughters, I think, marriage. She's 9 years, education, 9-year-old. So they have a time horizon of, let's say, around 7 years here, and the target is around 25. And for the marriage, if we take around 16 years as the time horizon, then the target is around 80 lakhs. And for the retirement fund again, they have a time horizon of 20 years, and the corpus required is around 2 crores. So, here again you need to look at the time horizon. When you talk about a time horizon of 7 years, it is decent, but not long enough that you can invest all your money into equity. So maybe what they can look at is set up a system through which they can invest in a balanced fund, equity-oriented balanced fund, or a large cap dominated fund through SIP. And for the remaining 2 goals, maybe the focus can be purely on diversified kind of fund. So I'm assuming a return of, let's say, around 12% for the first goal, which has a time horizon of 7 years. And for the remaining, I'm assuming a return of 15%. Now, if you look at each goal, for the first goal for the education, they need to invest 20,000 rupees per month.
Okay.
And for the marriage, it's around 14,000 per month. And for retirement, it's roughly around 20,000. Now, it's quite evident that if once they go for a house, they will not be able to save so much money or invest so much money for these goals. Now, important thing is, how do they prioritize their goals? My view is that the house has to remain as the topmost priority at this time, so they should go ahead with that. They will not have enough money to invest for all the goals. Maybe what they can do is they can begin investing whatever they can. After knowing how much EMI they have to pay, they start the process. Over a period of time, as the income levels go up, they can increase the amount that they invest for these goals. At this stage, it is not possible, I think, to invest so much. So either they have to maybe revise the targets, or look at the time horizon, or like I said, you start the process with whatever money you have and try and increase and get closer to the target that you have set for yourself.
That's the advice coming in for you. Well, on that note, we'll slip into break. We'll come back and continue taking up your queries, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. Hemant, we've got another query coming from a fairly young gentleman called Sachin Patel. He's 32 years old. He's married. He's got no kids, but he is, of course, planning a baby. His income is about 90,000 rupees per month. He's got 9 lakh rupees in savings, which is in debt instruments like FD and NSC. He's got 8.5 lakhs exposure to the equity markets. He's got an insurance cover of 12 lakh rupees. He's got a home and a car, so he's paying an EMI of about 40,000 on the home and on the car. He's got expenses of about 20,000 rupees per month. He wants help to plan his finances, to take care of his retirement and his kids' education.
Well, it's good to see that, he wants to plan investing for a child and also his retirement, which is the perfect way to move forward. But, here again, if we begin with the risk cover here, his yearly income is roughly around, let's say, 9 lakh rupees, which means that if I look at his annual income is around 10 lakhs, 90,000 is per month. So he needs basically a cover of roughly around 1 crore. What he has is insurance cover of only 12 lakhs. So there's a huge gap in what he should be having, what he has. So my advice to Sachin would be, first thing that he should go and make sure that he buys a term insurance policy and ensure that he's adequately insured. That is the first step that he needs to take. If I look at his other goals, here again, I think he's talked about only his goals, that he wants to start planning for investing for his child as well as retirement. There is no time horizon which has been assigned, and there is no target. Here again, to try and help him out, we assume that the time horizon for the child education is, let's say, 18 to 20 years, and for his retirement we are taking around, let's say, 28 years. The corpus that he needs to build up is maybe 50 lakh for the education and 4 lakh for the retirement. Here again, because the time horizon is long enough for him to invest in equity and equity related instruments, my advice would be that he should go with investing in equity funds through SIP. Now, if you assume a return of, let's say, 15% here, for the first goal for the child education, he needs to invest around 4,000 rupees. And for his retirement goal, he needs to invest around 10,000 rupees. So in all, he needs to invest around 14,000 rupees per month to achieve this goal. Two things here again need to remember. One is that every investor who has different goals over different time periods should create a separate portfolio for each goal. Don't make the mistake of having a combined portfolio. Imagine you have goal of child education, marriage, and also your own retirement. And you know that you need to invest 15,000 or 20,000 rupees. If you have only one portfolio, there is every likelihood that you may overspend at times for certain goals, or you may have a shortfall which you won't even know. So create a separate portfolio, and the fund that I would recommend for him is he can look at HDFC Equity, which is a multi-cap fund, ICICI Focus, which is a pure large-cap fund, and IDFC Premier Equity, which is in a mid-cap fund. A combination of these three funds will create the right balance in the portfolio. Now, if I look at his existing investment, I think there is a bias towards the debt, basically. I think there's more investment in debt at his age than equity. So I would want him to have a relook at it. And even within the debt portfolio, he's investing in fixed deposit and NSE. NSE, I can understand maybe he invested for saving tax. But if the money is invested in FD, considering his income level, he's in the highest tax bracket. He should be looking at tax efficient options like mutual funds. He can look at short-term debt funds. He can look at fixed maturity plans, which give you better return and also tax efficient. So he needs to look at that. On the equity side also, now that if he is going to go by this advice and start investing through SIP, he will be investing in mutual funds. And if he's investing in equities directly, I would like him to even have a look at that also. Because, there's no point investing in equity markets if you don't have the wherewithal to actually invest it properly. Don't invest just because you want to invest in equity. Give your money to a profession to manage. So if he feels comfortable about managing his equity portfolio, by all means he can continue. He can have a combination of investing directly in stocks and in mutual funds. But if he's not, he should try and make sure that maybe he can look at investing in good quality mutual funds. So that will ensure that professionals manage his money and he will be in a better control of his portfolio.
Investment Ladder, presented by BSC, Investors Protection Fund.
That's the advice coming in for you. Thanks, Atan Hemant, for joining us today. That's also all the time we have on this edition of Financial Planner. Thanks for watching. A lot more programming lined up, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.